this is a foundational transformation we see happening in the economy.
DeFi and blockchain are redefining business, economy, and ultimately society.
What's up, everybody? Welcome back to reDeFined, our podcast talking about emerging technology in blockchain, crypto, and Web 3.0, and most importantly, how it's affecting business, society, and our economy. I'm here again, Jeremy Almond, with my co-host, Megan Guy. What's up, Megan? What are we talking about today?
Hey, Jerry. Great to be back. I'm particularly excited about today's topic, which is near and dear to my heart and my day job. We're going to be talking about investing and all of the ways in which the blockchain and distributed ledger technology can help more of us to participate in equity markets, to participate faster, cheaper, more efficiently. And to kind of kick off the conversation, we have a special guest with us today. I want to introduce Dave Ferrall. Dave is the CEO of FinClear, which is an Australian company that is really at the cutting edge of this and of thinking about how to take costs out of the system, increase transparency, and provide greater access to all. So with that, Dave, do you want to quickly introduce yourself and share a little bit about what you've been up to?
Yeah, awesome. Thanks, Megan. Hey, Jeremy, thanks for having me here. Really pumped to be here, guys. So yeah, look, FinClear is a market infrastructure, access and technology business in Australia. We've been going about 7 years or so now. So we host a whole lot of wealth managers, stockbrokers, financial advisors, and increasingly fintechs using our infrastructure to listed products and exchanges.
Killer. Well, Dave, I think, people talking about the stock market, that's going to be a really exciting episode. We're all kind of engaged in different ways, whether you're in the private market, the public market, it's driving economy. So, I think one thing maybe just to kick it off, you probably can help articulate a little bit around how the current system works. Are there closing times? Are there challenges around kind of centralized systems? And how are you guys thinking about it? Because potentially blockchain and, DLT has the ability to kind of re-up all of that and kind of reimagine, how assets are sort of traded, right?
Yeah. Look, so we talk about a wagon wheel of service providers sitting around financial markets and layers of fees that going forward are potentially just not necessary. And one of the biggest ones to our mind is what's called a custodial infrastructure or nominee infrastructure, where investors don't hold those securities in their own names. So here in Australia, we actually have something quite unique. In fact, Australia and maybe one or two other countries have it. It's what's called direct investor name on register. In Australia, it's called a holder identification number or a HIN. And here there's an opportunity for investors to hold those assets, securities, listed securities, in their own name. Now, interestingly, we also have a custodial component to the market here, which is very much like the rest of the world, where assets are held in custody in wealth platforms. But one of the things that we talk about, we're big proponents of direct investment, holding those in your own name. And one of the things that we think the blockchain DLT technology is going to promote is tokenization of securities, and it's going to dissolve all these layers of service providers, fees and charges that sit around your assets. And so we're really excited about that and interested to tell you more about it as well.
You referenced DLT, I think, Jeremy, when you asked the question, talking about how that starts to peel away at some of these layers of middlemen and fees and time and expense. Can you explain just for our listeners, what is distributed ledger technology, DLT, and how does that differ or relate to the blockchain and crypto kind of writ large?
Yeah, look, I mean, I'll give you our really sort of simplistic layman's terms around what the DLT is or what it does specifically, we think, for financial markets. Really, it's just a smart contract. That's the way that we look at it. You have a centralized ledger, distributed ledger technology. We think of it simply as another form of ledger. It's more secure. It's permissioned by, either individuals or by in a central trusted ecosystem, by a central, trusted counterpart, so to speak. But the real advantage from our perspective is being able to embed what we call actions into that smart contract. It means that you can start to put things on the blockchain, on the DLT, not only ownership, but actions around types of securities, distributions, even news and notifications, so that when there's a scheduled action, everything just automatically transacts across that ledger. So that's from our perspective, we don't, try to get into too much of the actual tech, so to speak. I'm sure, Jeremy, you can probably, talk more about that than me, but we talk about the smart contract capability and what it does for financial markets, which is just simplify transactions.
And I think, Dave, one of the things you're sort of implying is the financial service infrastructure generally is quite crusty, right? A lot of it was built before the internet, whether that's payment infrastructure, or in this case, sort of clearing infrastructure. And so part of that is around, okay, well, if it's brought to the 21st century, can we make it faster and cheaper? And I want to talk about faster for a minute, because the smart contract, in theory, like that can be done in real time, at least on the tech side. And so I think people have maybe broadly heard in the news things like T+2 or T+0. I wonder if you could just maybe talk a little bit about that, because there's been a bunch of things in the news what happens when, stocks are cleared at T+2 and maybe stuff's happening behind the scenes.
Yeah. The other thing I'll point to as well, Jeremy, and I'll get into that as well, is what the technology allows is a single source of truth, right? And I think everyone, talks about that. But what that means from our perspective is that there is a single source of truth. We always talk about lots of counterparts using data, using it for their own purposes, and then adding their own sort of function over the top of that. And so, what we call that wagon wheel, or those layers of fees. Whereas what this allows firms like ours to do, and others, is to have that single source of truth and perform many functions around it via a smart contract, rather than all these individuals, performing their own individual functions, so to speak. But yeah, look, instant, I guess, transaction times or real-time transactions time, particularly on clearing and settlement, or what actually becomes settlement, because there's no actually clearing function. And what do we mean by that? So T+2, everyone's heard about financial markets and T+2. So, years ago when I actually first started in markets, it was T+30. So when you bought and sold a security on an exchange, it took up to 30 days to actually, if you were a seller, receive your money, and if you're a buyer, when you actually had to pay your money. And what that does is create a whole lot of counterpart risk. And by that we mean, if you're the buyer and you've got 30 days, or now down to 2 days, there's obviously some risk that you don't actually pay that money over. You've got 2 days to pay that money over. Likewise, if you're the seller of the securities, you've got to deliver those securities and receive cash for them. So there's a delay. So what that means is, to mitigate all that risk, the system's built a whole process of margining and collateral to support that risk, meaning that for brokers, clearing institutions, settlement participants, banks, they have to post to a central, what we call a CCP, central clearing participant. In Australia, we have one called ASX Chess. In the US, the big one's called the DTCC. What the function of that is taking margin from participants like us to ensure that the end clients actually pay the cash or don't pay the cash, because those central counterparts don't want to take any risk of failure in the infrastructure. So when you start to get deferred settlement times, obviously that risk comes in, then you have margining and collateral to support it. Whereas if you can collapse this whole ecosystem into real-time transactions, well, then all of a sudden you can get rid of the capital and the margining requirements to support that. And you have a much more efficient and real-time ecosystem. And really, what smart contracts are about in the DLT is real-time capability. We see a world where, there are two big efficiencies, I guess. Assets held directly in a client's own name, so no custodian being an intermediary to holding assets. And then secondly, collapsing this into real-time settlement and taking away all this inefficiency around collateral and credit.
Awesome, Dave. So, like, one of the things, I want to linger maybe on the speed for a moment, right? So T+2 versus T0. I think many of us, at least, got more familiar with it over the last year because it's been, kind of in the news around these meme stocks. I don't know if I want to venture too far in the conspiracy theory. A bunch of retail investors on Reddit got involved in trying to push the stock price up and push out, some of these private equity folks. The market got paused, and then arguably, the losers in this case were retail investors, and the winners were private investors. So that's kind of like arguably one problem with T+2. Another problem is sort of this notion around front running. So, do people have proprietary access to the information? And so I guess what I'm wondering is, boy, if everything was real time, it seems like that would be better for normal people and sort of democratizing access. But it also seems like institutions might not want that because they might have, their insider access that might go away. Am I reading that right? Or
100%, 100%. Because the US runs a different structure to Australia. I spoke about that before. But the big losers here are the custodians and the investment banks, because they're holding the stock. They're lending the stock out, they're using the stock, and also they're taking the trading volumes. And so, there's a whole argument around whether they're allowed to or not front run, or how that works in terms of electronic trading. What happens is, if you start to see real time and you also start to see investments being held directly, well, then all of a sudden you have no capability for consolidating stock into nominees or custodial and lending that stock. All of a sudden, it's directly held in investors' names rather than by custodians, and they're trading direct to markets themselves. So there's no capability to intermediate that flow. So that's one of the big sort of, I guess, underlying structural problems in markets.
Yeah, Dave, I was, when you were talking and when you've been, sharing what FinClear has been up to, one of the things that kind of came to mind for me was in the States, and it's culminated in a lawsuit now. There was a company, they went public. There was a bunch of miscommunication, disinformation, I'm not sure. But at any rate, employees that were looking to cash in their shares weren't able to, basically, for several days because they had to work through transfer agent, clearing, and everything else. The shares ended up dropping, 60% or something like that over the time. So people lost a huge amount of money, right? Employees that have been working really hard at this company for a long time. That's the whole reason you go work at a startup, right? Is hopefully to realize some gains when finally you get liquidity. How do you think about, you've been thinking a lot, I know, about in Australia in particular, private markets, and how you start bringing some of the, same concepts we have for public markets into the private market sphere, but in a way that's better, that gives, better transparency, faster, more efficient access. Can you talk a little bit about that? Like, would distributed ledger technology potentially have been able to help?
We've recently just launched our own initiative, or our own exchange and platform down here in Australia called FCX. And we're able to build, from the ground up, from day one, what we think the most efficient ecosystem is to support private companies. And it starts with, again, using a DLT capability. It starts with a register, or being able to tokenize and put your holdings directly into an investor's name, and then linking that capability, that register, then to a capital raising capability or a secondary share sale capability, and ultimately through to being a registered exchange. And so you start to have that central ecosystem there again. And a big piece of it, of course, is it's real-time settlement, to talk to the inefficiency around T+2 before. So we've built this ecosystem from the ground up on the DLT, real-time settlement, and investor's name directly onto token or digitized, meaning that those sorts of delays that you saw there can be avoided completely.
Jeremy, is Paystand going to list on FCX? There's some new options for you.
What I can tell you is, like, as a private company that's growing a ton, the amount of mess in just sort of digitizing, stock for every employee, as Megan said, it's really, really important for every single employee, to feel like they have a place of ownership, because you're putting your blood, sweat, and tears in to hopefully, like, make a dent in the world. And, I think honestly, for many early stage employees or even late stage employees, it's pretty opaque, the process, right? And so transparency in the process and in a sense of like ownership is I think really, really compelling and exciting. One of the things I wonder then is if you tokenize the stock, are there other things that you end up getting to do with that financial product? Like I know, for example, not everybody can afford to exercise their shares. So like, is there ways that you can help like set lending against it, or you can get secondary markets where, people can take chips off the table without having to wait for, 10 years or whatever for the company to go public? Like, does it sort of open up new kind of avenues where right now today the line is really hard drawn? Public, private, lots of liquidity in the public market. Private markets kind of like you just have a piece of paper and you hope in 10 years like it works, it's something.
No, 100%. Yeah, 100%, Jeremy. That's what FCX will be about. Eventually, it will be an exchange, but for unlisted securities. Now, it's not an exchange, I guess, as we know it. So an exchange that opens at 10 o'clock in the morning and closes at 4 in the afternoon and just trades all day. But it's the type of exchange where liquidity can be sought on demand and potentially up to the corporate. So the corporate may say, well, we're aware of all these shareholders, employees of the company, that might want to sell some shares, and we know that there's some demand. So we're going to set a liquidity event. We might set it once a week, we might set it once a month or once a year, or just whenever we feel like it. So it's the corporate actually dictating the terms and saying we'd like to provide some liquidity to our employees and our shareholders, and doing it through a what we call a simple auction or book build process. And that's very easy to manage when you have this centralized ecosystem that we're talking about here. Everything's on the DLT. And to go to your point before, the smart contract knows whether, say, you as an employee are able to sell those shares because it's hard-coded onto the DLT. You have a 3-year vesting period, or you have other conditions. It knows. So if you go to put those on the exchange and want to sell them, it may well say, hey, actually, no, it's 364 days and you have a 1-year, 365 vesting period. You can't sell those shares today, but tomorrow you can. And you can go online. So what we've done is actually build a digital wallet attached to that, where an employee can then go into the website or on the platform and see their securities, their tokens held directly, and elect what they want to do with them.
It's really interesting. So I think, Dave, I wholly agree, like on both the, corporate side and the employee side, there's a lot of really interesting opportunity it sort of unlocks. Megan, I'm wondering, like on the investor side, we're sort of blurring the lines now of these new sort of assets, the way we can think about stock, because historically it's like venture in the early stage, you have sort of growth in the late stage, and then the company goes public. But now we have SPACs, we had ICOs, though, that was kind of a weird form, right, of tokenizing early stage companies. We have IDOs. We now have secondary markets. We have, potentially decentralized or distributed versions. So like, how would you as an investor kind of look at this, sort of asset class, and how does that change kind of the investment landscape when there's sort of different products now of stock that, an investor could get involved with?
Yeah, I mean, I think it offers so much more opportunity, right? Greater transparency. Like, you often will see venture firms like my own that will do some secondary, right? So we often want to get more money into a company, and the company is not looking necessarily to raise or issue additional primary equity, but they are often looking to provide some liquidity to early employees. And historically, that's been kind of a fraught and slow process. But I think some of these new innovations, like what Dave has built with FCX, potentially really speed that up, right? Or create greater visibility for you, the CEO, and having those conversations, and hopefully speed of transaction and close as well. Which is something I think everyone is always looking for. So more flavors, I generally feel like, are always a good thing, right? You can always kind of find a home and meet but the idea is matching the right source of capital with the right need for it at the right time, right? And sometimes that's really patient, long-term venture capital. Sometimes that's like quickly transacting meme stocks even. So one's not necessarily better than the other, but I think the variety and the increased access is going to be a net positive for sure.
Yeah, I agree. It's sort of having different assets at different sort of levels of risk and different levels of maturity in the market. That's typically been a privileged class, right? Like, only certain investors get access at the early stage. Secondary is actually a fairly mysterious thing for people. Like, so in case you're not familiar with secondary, that's a case where normally in the earlier stage, a company will sell their primary shares, but in this case, it would be employees selling shares to investors. And so these are sort of different instruments. I guess my question is, to either one of you, what ends up happening to the regulatory landscape in these kinds of things? Because, typically, at least in the US, you have to be an accredited investor, you have to be an institution, to invest in the private markets. There's a lot of kind of complexity around how that gets regulated. In the public markets, right? Like, the company's at a certain stage, so their disclosures are very different. And so it has a lot of protection for retail. And then what I think we're sort of finding is in the middle, it's this kind of gray area, right? Whether it's, SPACs, which have making statements, may or may not be a problem. And then, ICOs were not great, right? In some contexts, even though maybe their intentions were good. So what happens in this middle layer? Like, how do accredited, non-accredited, all the compliance and regulatory pieces deal with these sort of new products?
I think that's a great question, Jeremy. And one of the ways that we look at it is in Australia, we have a sort of benchmark that separates retail investors to sophisticated or high net worth investors. And it's actually under debate at the moment around what that benchmark is. It draws a line, so to speak. What we envisage, and we are at the moment just targeting FCX at sophisticated investors, and so not necessarily retail. But that regulation in terms of retail is obviously very, very tight. I think that's going to loosen, I guess, over time, because I think investors are looking for more opportunities. I think investors now realize that mature markets, listed markets, can not be, not necessarily all that interesting. There's a lot of really, a lot more exciting stuff going on over here in that unlisted space. But I also think it's important that there's some sort of framework around that. So it's one of the reasons that we'll be a licensed exchange in Australia, and we will actually onboard, there'll be onboarding requirements and infrastructure that clients have got to come into and be onboarded and be validated into that platform. So we think it's important that, and we look at it as almost like a junior bourse or a lighter regime leading into fully listed land. And so I think that's the interesting part here. And as you say, the lines are being blurred, but I think that it's important to maintain some regulatory oversight, scrutiny around this. I mean, obviously investors want comfort that they don't invest in a company on a private exchange, say today, and tomorrow they just put the flag up and say, oh, sorry, we're done, we're busted, right? There's got to be some sort of tighter regulatory regime around it that gives investors that comfort. So that's one of the things that we're grappling with, or we're working on at the moment, because we want to be seen as a feeder exchange, but a more lightly regulated, platform before you go into fully listed securities. So it's getting that balance right, which I think is going to be really interesting.
Yeah, it's a really tricky balance, isn't it, between being kind of patronizing and gatekeeping and telling people they can't participate in, these private markets where you do see enormous, very quick wealth creation in some instances, right? And so you want to sort of provide access to a broader group of people, but at the same time, these are incredibly risky spaces, right? And we know there are nefarious actors, and it's been interesting to, have conversation with you over the last couple of years and see some of that dialogue evolve. And, I think we're seeing that in the States for sure, but the precise path, I think, still is a little bit TBD, and we'll probably have a few more of these scandals that bubble up in the intervening time while we get it right.
Well, you've got two big bookends at the moment, right? You've got regulated markets, listed markets, and what everyone calls the Wild West frontier, which is sort of which is crypto a little bit, right? And so they're trying to bring those worlds together. I mean, at the moment, anyone can go into an unregulated crypto exchange and buy crypto assets, right? Whereas in unlisted securities, that's not necessarily the case. And I think that what's going on is we're trying to build this middle ground and still, provide access to some of those products, but coming from a lighter touch regulatory regime.
I mean, you've seen there was a company, I can't remember what it's called, but I saw an announcement, just the other day, like there's like fantasy football now for startups and companies, right, that are building out platforms to let people feel like they get to play along and invest because they can't actually necessarily put their own money to work. So, yeah, I'm hoping, FCX is just a harbinger of things to come that enable more of us to
gaming for
participate
financial
in the other
markets.
Yeah. Well, I mean, look, if you can go to Las Vegas and bet on green, right? Like at some level, how do you enable the middle ground? I think, Dave, you made a really interesting point about crypto right now, like is almost a bottoms up funding mechanism where, many of the companies, even in utility tokens kind of perspectives, you can capitalize a white paper right now, right? Like no product, no market, no tech yet. And you can capitalize that. And the regulators have been kind of dealing with that. And then, like you said, on the other side, there's like high level of scrutiny. And the middle is a really interesting place because arguably the middle is where you have value creation that could be more democratized. Meaning, back when I got involved in tech, in the early .com days, and even well before that, some of the companies we know the best that are like, think of the Microsofts of the world, the Apples of the world, the Amazons of the world, they actually went public much, much earlier in their life cycle. And so what happened is, retail, normal people got access to all of the value creation as that company grew. And they got to participate, right, and kind of vote with their dollars on seeing those companies create, these massive sort of things in the economy. And now it's sort of like retail only gets access to it at the very end of that cycle. And, institutional investors have a really, really important part to play. I personally think, especially so at the early stage, like that's the part crypto is a little bit off. At the early stage, it's really, really important to have like known entities that know how to get a business off the ground, can help the organizations. The next stage, perhaps you want to blend. So I don't know what the right middle ground is, but I hope we get there.
Yeah, you raise a really important theme, obviously, Jeremy, and that's, companies staying private longer and potentially never going public. And we've got some big companies, even here in Australia that probably have no intention of going onto listed public markets. And that's a really interesting dynamic. Again, one of the reasons, obviously, why we built FCX. In the US, unlisted companies are supposedly, a quantum of 10 times listed companies in terms of market cap size. And similar here in Australia. It almost seems undemocratic, right, that investors shouldn't be able to get access to those companies.
We can't keep beating up on Megan's industry. But you do kind of raise a point, I guess, on the global side, right? Which is, these markets are also regional-based markets. As they become more decentralized and distributed, what's the role in globalization in this? Does it, do they stay regional or at some level does whether it's an FCX or otherwise, do they sort of cross what's historically been regional boundaries?
It's a really interesting question. I'm not sure I have an answer on that one, Jeremy. But maybe a year or two ago, I would have been firmly in the global camp and of big centralized, multi-currency, multi-jurisdiction exchanges, right, crossing over, and now with what's going on, and the world, moving away to globalization, and it's a tough one. It's a really tough question. I like to think that technology will solve many of these cross-border complexities, but the regulatory environment between many are just so diverse that it makes it on one hand you might want to see it, but on the other hand you see it very difficult as to when it's going to happen now. And obviously that big trend, which I think is going to continue as soon as you start to see not just private companies but even public companies think about what are the advantages of individual investors owning their own securities in their own name. You think about the advantage from a corporate perspective of the transparency and the ability to communicate directly with their shareholders, investors. It's a really exciting world. When I look at it, I think it's some time into the future, but things are just happening so fast now and accelerating. And it's been driven by this technology, by the DLT, blockchain, and it's really exciting to think about what could happen in the coming years.
Yeah, and I do wonder, like, as we drive globalization, there are now, sort of economic big muscles to move around things like sanctions and otherwise that have like big impacts, right, in the swing of globalization on these systems. So thanks for being on here, man. This is a topic I think is extremely interesting. Just awesome to have you on, man.
Yeah, my pleasure, guys, and obviously a passion for me to talk about it.
Well, Dave, thank you so much for spending some time with us and sharing what you've been up to. Where can private companies that are eager to have FCX come to the U.S. Or elsewhere find you? What's the best place to learn more?
Yeah, look, we have a dedicated website for FCX, fcx.com.au, because we're in Australia. Don't forget the AU on the end. Or else FinClear is our sort of corporate headquarters as well. We're just opening up at the moment, so we have our own FinClear shares on the DLT, and we're inviting our investors at the moment to come in and open up their digital wallet and put and see their tokens, their shares on there. But we're bringing other companies on shortly over the coming months, and then we start to do more interesting things like providing capital raising tools for corporates to be able, primary issuance or even secondary transactions. And then we have an exchange license pending, which we hope will come through next year sometime, at which stage we have a fully blown ecosystem central platform. So come onto our website or hit us up. Always happy to answer questions.
Awesome. Well, Dave, thank you so much for joining us. It's been a really great conversation. I'm really excited about where your technology and so many others is going to take us and give more of us access and efficiency in these markets. So thank you for all the work you've done. And thank you also to all of our listeners. We're delighted to have you guys participating here in the reDeFined podcast. And stay tuned. We've got lots more great conversation to come.